welcome to TheoTrade. This is Don Kaufman. It's January 17th, 2020, and you are watching the TheoTrade Weekend Update. All right, the question I think on a lot of traders, a lot of investors' minds, are there signs of a bubble emerging? And we're going to cover that here momentarily. Some of the data is my own. Some of the data is a little bit anecdotal. But we also have a quantitative firm that I'm actually going to show you some of their data from and try to derive an answer here. Are we effectively inside of a bubble right now? And really what some of those signs may be. Before I get there, I have to give a quick shout out to the fact that the SPX cracked through its expected move. That's the first time, okay, after 23 weeks of an efficient marketplace. Here we are in the 24th week. We finally smashed the upside of the expected move. It means a lot, people. And I'm going to show you that specifically when we look at a couple of charts and a couple of trades here momentarily. Now, before we go any further, let's jump right back to the topic. Signs of a bubble. Listen, at this point, push aside whether you're bullish, whether you're bearish, because we could talk about that till we're blue in the face. I mean, if you're bullish right now, you're pretty much looking over your shoulder. You're nervous about your positions because, I mean, people are telling me right now in email, they're waking up in the middle of the night and they're literally looking at the futures in the middle of the night and they're like, okay, I can go back to sleep. What do you expect? Huh? You're nervous, aren't you? You're looking for like a 150 point gap to the downside because it's too good to be true. If you're bearish, you're just taking heat on a day-to-day basis. It's kind of ironic that whether you're bullish, whether you're bearish, you're having a tough time sleeping. Now, here's an aspect that I have been looking at, and I'm going to get really specific. Listen, as I said, we could talk bullish or bearish. Valuations are next to impossible at this point. What are we going to do? We're going to look at what? Tesla, right? What are we going to look at? Apple? The iPhone 22 may actually really be good. You can't really argue too much about valuation, and I'm not going to do that. And again, we're going to look at some very quantitative data here in just a moment. There is an aspect, though, that I want you to look at, and we are going to look at again here in the charts in just a couple of moments, and that's this. First up, I want you to look at the utilities. XLU. Whether you're doing it with me in the chart here in a second, or you're looking at it on your own right here, right now, look at the utilities. It's very difficult, okay, to make an argument of why they're buying utilities like they're going out of style. Like, you know, I always say, like, the utilities, what are they, the cool kids on the block? You're like, oh, I need utilities because they have some yield to them, right? You know, maybe the hunt for yield is on, but why? Well, the marketplace is spurting to the upside. Utilities just getting caught up in that. All right, let's push utilities aside for just a second. Now, I want you to look at junk, okay? I prefer to look at HYG. Again, HYG in terms of junk, it's junk debt. Junk debt is exploding right now to the upside. And I don't think that anybody can make a great argument of why right now the marketplace, it loves junk. In the end, it's just junk, which we're going to show you here. And it's difficult to make a valuable argument for valuation. They're like, yeah, we need some more really, really bad debt. Listen, if the marketplace sells off, junk typically gets absolutely hammered. But right now, the search for yield is everywhere. And you kind of feel like asset managers, people, it's caution to the wind right now. They are throwing capital at this marketplace. Again, in terms of signs of bubbles, I'm not necessarily here to argue valuation because I don't think, again, that it's going to be next to impossible to do. I'm here to argue, look at a couple of specific products, maybe products outside of your comfort level. And with that, we're also going to show you here momentarily some very quantitative data. Let's get to it. Some charts, a couple of trade ideas. Continuing with our theme, are signs of a market bubble everywhere? And really comes down to, should you be concerned about this rally? I mean, just take a look at it on the screen here. We are starting off in the SPX, and people, that is awe-inspiring. I mean, take away all the drawings and everything I've got on the screen right now, and all you've got is what? Yeah, maybe one or two downticks in terms of trading sessions since effectively October, which I'm going to talk about here in just a moment. And before I do, let's cover a little bit about the SPX and the expected move. One of the things, again, you know, if you're just an investor, you don't necessarily get into markets too deeply. The expected move sounds completely foreign to you, but it's what's been driving a huge amount of the order flow lately. And one of the things that I want to start to point out here is, again, we just passed through, all right, 23 weeks effectively inside these little hash marks. And what those hash marks represent, now cruise over to the SPX options chain for just a second. The options marketplace, right here, right? Now that options marketplace, that's 7 days out into the future, which is next Friday. It denotes that we're going to have about a $29 move, either higher or lower, okay, by the close of next Friday. All right, I kind of take that with a grain of salt, except when it happens for 23 weeks in a row without fail. And we're not just closing inside of the expected move. And when we start talking about expected move, and again, I don't want to geek out on you too much over here, but I do want you guys to understand you're supposed to be inside of these brackets being this, you're supposed to be inside those about 68% of the time. Yeah, well, after 23 weeks, we finally cracked outside of it. And what we have learned, okay, and again, this is not enough data, I believe, okay, to make, a definitive, or quantitative kind of valuation to this. So if I had to make some very definitive call, I wouldn't do it with the amount of data set that I have, all right? I only have about 3 years, okay, of hard data. That's 3 years, and 3 years is pretty good, but when I'm ready to actually say something, I usually say it with thousands of occurrences, and I simply don't have thousands of occurrences. I'm going to do the best I can with the data set that I have, okay? But one of the aspects, okay, that really has seemed to resonate, if you look back, and I'll just zoom into the most recent year, when we start to crack the expected move, that is, hey, we were supposed to move this past week $38. We didn't move $38, right? We moved $38 and then some. I mean, the edge of the expected move right here, let's zoom in on it, was right around 33, okay, 03. We closed the trading session over here, all right, substantially higher. Oh, how much higher? Well, almost $30 higher. So we hit almost what we term a 2 deviation move. If you're looking at a distribution curve, all right, instead of making that $38 move higher, we didn't. We closed almost 2 sigmas out, all right? That's that kind of move. Now, the big takeaway from here, and this is the one where I'm going to go out on a little bit of a limb because I don't think I have necessarily enough data points. When we start cracking through expected moves, the markets, okay, move from periods of incredible efficiency to periods of inefficiency. Inefficiency, okay, I don't say that like, oh, there's mispricings. It just basically means all of a sudden, Mr. Toad's wild ride breaks open and we have subsequent occurrences of breaches of expected move, right? And if you take a look, right, just what I'm highlighting on the screen, these are all breaches of expected move. It happens, then we mellow out, and it happens, and it happens, and it happens, and it happens, okay? So we're actually very likely at this point to see more of these breaches, which what I'm getting to is the market has been, again, totally efficient to the upside. There's not been really that much unusual trade action around this rally. No matter what you may hear and what conjecture you may hear, okay, listen, none of that resonates with me until you got statistics to back it up. And here's the stats. The market's moving like it's supposed to be moving. It's dictating on a week-to-week basis for the last 23 weeks precisely what it has been moving until this week when it cracked wide open. Now, there's a lot to be learned from looking at these expected moves. There's also periods of the extreme. And the extreme, okay, this is where people right now are comparing the run-up that we're seeing in the S&P. Okay, they're comparing it to, 2017, 2018. Well, here's that run-up inside of the S&Ps, but there was marked by a lot, okay, of breaches of expected move to the upside, and then wild breaches of expected move, of course, to the downside. So the big takeaway from here, okay, is moving forward. Moving forward, and moving forward is what? Well, last week we had a $38 expected move. This next week of trade, now reminder, Monday markets are closed, okay, for the Martin Luther King holiday. Nevertheless, we have a 4-day trading week and a 29.81 expected move, right? So that is really, it's a contracted expected move. You got to think about this. We just saw what? Instead of a $38 move, okay, market smashed all the way up like $70. And yet they contracted it now to $29. That's a little bit scary. And that's what I want you to kind of take away from here is this seems to be a time, okay, to be a premium buyer. I'm going to say that again, to be a premium buyer. If you trade options, I do believe you want to be a premium buyer in here right now because, again, they've contracted the implied volatility. We just smashed through the first expected move. We should look for a little irreverence, if you will, in this marketplace, okay? And I believe that that is the big takeaway from the data specifically here. Now, if you're comfortable, okay, with taking away, data after like 3 years of data, you're like, yes, this is, gospel. That's fine, okay? Me, I need thousands of occurrences to do so. Now, let's move into something that is far more quantitative, all right? And that's my geek speak, if you will. Something that's far more quantitative. You got to be thinking to yourself at some point, too far, too fast, it's moving too quickly, okay? Slow it down. I mean, here, pull up the spiders on this front, okay? This most recent run in the last, okay, basically October, November, December, really what we're looking at is the last 67 trading days, right? You're up 13% in the last 67 trading days. So with that, I decided to pull up some data because, this really resonated with me. 13% in the last 67 trading days, it resonated with me. So I actually read almost on a day-to-day basis, okay, a quantitative kind of letter here from a company called TheoTrade. And it's not often that I ever mention any outside firms over here, but it's kind of quant speak, a little bit of geek. And they actually broke some of this data down. Now, they looked at and they assessed, okay, how unusual an 11% move is, okay, and 3-month return. I mean, think about that. 11% move in 3 months. How unusual is that? TheoTrade pulled the S&P 500 daily return back, okay, to 1990 and ran rolling 65 trading day returns. So if you think about this, all they basically did is they said, hey, listen, we moved up 11% in 3 months. Going back to 1990, how often's that happened? Now, the reason I said this is very quantitative because for the most part, it is. That's why I said you got to have like thousands of occurrences. This one's pretty good. There's a lot of 3-month periods between, here in 1990. Now, okay, number one, we're certainly in an unusual spot, right? Since 1990, 3-month returns have averaged 2.2%. So an average 3-month return since 1990, 2.2%. Compound that into a year and you get 9.1%. Makes a lot of sense because the S&P's return is pretty close between 8 and 9% on a year-to-year basis, okay, on average. Now, the standard deviation of those quarterly returns is 7.3 percentage points. That means any 3-month return, okay, between negative 5.1% and plus 9.5%, okay, is in the meaty part of a distribution curve. All right, so this is kind of what I was talking about with the distribution a little bit earlier, but for the most part, what you're looking at is returns in the meaty part of the curve, anywhere from negative 5.1%, okay, on up to 9.5%. That's, again, the meaty part of the curve. That's your 68% of occurrences between, negative 5 and 9.5. So what do you got? Right now, we have a return that's, out here. It's 11%. Now, today it's even higher. When we, put this together, it was again, they put it together a couple of days ago. It was only 11%. Now it's 13%. We are definitely outside of that curve, people. Outside of the curve. Now, with that, all right, number two, okay, a look at just the last 15 years, 2006 to present, shows the S&P 500 has rarely rallied much more than 10%, okay? That's the one standard deviation upside level, unless is snapping back from a serious prior downdraft in the very recent past. So I'm going to show you a chart here. The chart below shows that 10% is usually a hard cap on 3-month returns. We've exceeded that. We've already hit now 13%. Okay, but either before or after the financial crisis. So the financial crisis, there's a lot of snapbacks, very, very similar in a 3-month period where you actually rally 10%. The only real exceptions are mid-2009, late 2010, late 2012, and early 2019. In each instance, the S&P, okay, had recently pulled back more than 10%. And I'm actually going to show you that 10% is usually a hard cap on 3-month returns. All that you're looking at, okay, in this particular slide, again, provided to us by TheoTrade, is none other than returns. Okay, did we get, and do we often get, huge returns, okay, north of, for instance, 10%, and in a 3-month rolling period? And the answer is yeah, but really only after, okay, huge sell-offs do we get these huge rallies. It is incredibly rare to see such a large move, if you will, okay, in such a short period of time. It's a big takeaway. Let you guys, peruse these as you will. The third point, okay, you have to go back to 1990 to 2005 experience to find a prior period when the S&P managed, okay, to rally materially further, okay, after a 10% 3-month advance without the prerequisite, right? Prior near-term 10% decline, meaning that if you looked back over here, okay, every one of these huge rallies that we saw, as big as the one we're in right now, was preceded by a big sell-off. And I want to reiterate that. There was always a big sell-off, then we rallied. There's a big sell-off, then we rallied. There's a big sell-off, then we rallied. Okay? You have to go all the way back, right, into this time frame, 1990 to 2005, to actually just find outpaced returns in that short of a time frame. All right. Mid-1997 was the first instance. The peak was 25% in a 3-month return. Insane, right? It happened again. Okay, 1998. 1998, obviously entering into a bubble period. That and the fact that a lot obviously happened in 1998, including long-term capital management. Important, annualized S&P, okay, earnings growth was accelerating during both of those periods. From Q1, okay, to Q3 1997, it went from 7% to 11%. From 1998 to 1999, earnings growth accelerated from 1% to 20%. So Q1 1998 was looking forward to that improvement. Basically, the last time we rallied like this, earnings improvement was just a smash hit. That's the big takeaway over here. They knocked the cover off the ball in terms, okay, of what? Accelerated earnings growth. Now, bottom line here from TheoTrade, upcoming earnings reports and management guidance. I put a lot into the guidance. Have to be great. Okay? Spectacular, if you will, in order to keep the S&P 500 from succumbing to the weight of statistical gravity. Some big takeaways in that to kind of answer the question, too far, too fast. Again, now we're up 13% in 67 trading days. It is, again, all now up to earnings. Now, I wanted to put that in there. I'm not huge, okay, into fundamental analysis because I don't think you can make some great fundamental arguments, okay, for this marketplace. Nevertheless, in comparing it to data all the way back to 1990, it's pretty spellbinding, the type of move that we've actually had. Moving forward, okay, here, this one comes from me. They're buying junk out there like it's going out of style. I want to bring up the HYG. In terms of the HYG, it has had an absolutely stellar upside move. Now, people, this might not look like a lot to you, okay, but the kind of returns that we're seeing in junk, right, you kind of think to yourself, they've just run out of assets to buy. You can't make a great argument for junk either. If you take a look at interest rates, and I'm going to look at TNX for just a second, TNX hasn't really done very much over the last couple of months, all right? Since this rally kind of ensued, we're stuck between 1.8 and 1.9%. So when you start to make arguments for HYG, the only one you can make is the search for yield is on. But okay, so I get it, all right? They're out there and they're buying a 4.27 like yield. It's junk, okay? But if the marketplace were to sell off at all, this thing is going to suffer horrifically. Think about the risk reward inside of junk. This is my argument. in terms of like looking at this and thinking to yourself, if there's signs of a market bubble everywhere, this is how should I say this nicely? Bubblicious. It's bubblicious because, again, the risk reward in here is horrific, and everybody going out there to buy it would know that. This is an incredibly illiquid product. Okay? The moment there's sell side activity in here, this thing is going to drop like a rock. It's going to be out like a hot potato. The only reason, okay, that I can fathom that anybody's out there buying junk right now is because they must think that the 10-year is headed back down to like next to nothing. And the 10-year is still under 2%. They must think that the 10-year is going down to like 1%. It's the only rationale that I can come up with of why you buy junk, other than just outright blatant, okay? There's no place else to put your money, and we're in a massive bubble over here. Very hard to rationalize why they're buying junk. Now we move on, okay, to XLU. What I kind of call utilities. They're the cool kids on the block. You got to be kidding me. You have to look at this on a year-to-date percentage. Why am I looking at utilities on a year-to-date basis? Well, utilities are up almost 5% on a year-to-date basis. Time out. Let's pull up Apple for a second, because Apple's up about 6%. So are utilities as cool as Apple? Maybe, because that's how far and how fast this has moved, right? That's, again, putting some rationale behind it, okay? You're not going to make great arguments to me that this is not a sign of a bubble. Now, I can make arguments, why are they buying XLU? Maybe they're buying XLU because they're scared that the rest of the marketplace might collapse and everybody will want to come in here. Or, okay, XLU, you could also probably make the argument that, hey, guess what? Maybe you think interest rates are going back to zero. I just said that a second ago, with what? With junk. But any way you want to look at it, capital is piling in over here. The volume isn't even picking up. All right. We're just trading into to no person's land at this point. So to further this, all right, we're in ludicrous mode and valuations. Now I threw the ludicrous mode in there for those of you that have looked at Tesla lately. Okay. If you don't know what like ludicrous mode is, you're missing out. Let me tell you. It's a lot of fun is what it is. So if we bring up Tesla, okay, one of the things I don't want to do on this video is try to get into valuations. It's impossible, again, to start talking about valuations. That's why I looked at utilities. That's why I looked at junk, okay, because you can't make great arguments about valuations in either one of those. You can't make great arguments of why those are rallying, okay. When you start to look at valuations in this marketplace, you start to think to yourself, this is ludicrous. Hence Tesla and its ludicrous mode. Neither here nor there. You're not going to see me pull up, too many Googles and so forth. By the way, Google finally hit the $1 trillion club. Joined now by Amazon, okay, by Apple and Microsoft. So effectively, the 5 largest tech companies are over a $5 trillion market cap now. $5 trillion market cap in the 5 largest technology companies out there. That's why I've always called them the monsters of tech, hitting an all-time high effectively today. Push valuations aside. Next on the docket here to talk about are the financials. You got to keep eyes on the financials. And I'm going to tell you why you got to keep eyes again on the financials. And I keep reiterating this week in and week out. If the marketplace is going to continue to make that smash hit to the upside, it has to be done on the back of the financials. Except the financials, okay, have been trapped. And let me zoom out and zoom back in. The financials have been trapped in an incredibly tight range and continue to be trapped in that range, even with the upside breach of expected move, right? We are now sitting on 1, 2, 3, 4, 5 weeks, all inside of the expected move over here, and really in an incredibly tight range. And we expected more out of the financials this week. Why? Because they had their headline, right? They had all of their earnings, all right? So keep an eye on the financials into this next week of trade. They are going to be shifting, okay, the S&Ps. Sure, again, the S&Ps continue to rally this week, and the financials, they did bid up. There's no question. The financials, okay, were at the upper end of the range, but they haven't smashed outside of that range, okay? And I caution you, if this marketplace is eventually going to break and things are going to get downright hideous, it's going to be done on the back of the financials. Sure, tech is going to be heavily involved. Then we move into earnings headlines. Okay, in this next week of trade, and again, we have a shortened week coming up. The next week of trade, though, it's going to be earnings extravaganza. Underlyings like Netflix are going to start to kick off. And the reason I'm bringing up earnings in here is not to tell you whether to get bullish or bearish. Listen, we're going to do lots of earnings trades. You guys know I like to do earnings-based butterflies. Okay, push that aside for a second. Earnings, again, they have to knock the cover off the ball. And I want you to remember that. It's not about even what they did in the fourth quarter. It's going to be about guidance. It's going to be all about guidance. And the companies that have released so far have actually done relatively well. Last but not least over here, we're going to hear out of Davos. So what is Davos? I don't know. Okay. A bunch of monkeys freezing themselves, in the middle of nowhere. But you're going to have a lot of CFOs there, a lot of CEOs. Okay. Are they going to continue to warn? Remember that a tremendous number of CFOs in the S&P 500 have now warned, okay, of slower growth in 2020. That's why I said earnings headlines are going to mean a lot. These CFOs could be warning from Davos. You're going to see a lot of more economic data out there, housing data. One thing, I'll just throw this in there for just a brief moment. If you haven't looked at XHB, okay, here's another one. I think you can probably make great valuation arguments for XHB, but XHB, it looks just like junk. It looks just like the utilities. This thing missed out on the rally until effectively the last couple of trading sessions. And when you look at it on a year-to-date basis, and again, on a year-to-date basis, if you take a look at this, you have the housing, okay, up, again, almost as much as Apple on a year-to-date basis. Things, people, are getting downright nutty. Last but not least on here, I put up housing and trucking. There are a lot of old school traders talking about a collapse right now in terms of the trucking industry, all right, and transport industry. And I will also throw this up here, CSX, okay, ironically guided lower. I want you to remember this. They guided lower. The stock actually finished the day, for the most part, massively unchanged. Listen, there's a tremendous amount to think about in this weekend's update, okay? A lot of it, though, absolutely has to do with signs, okay, of a bubble, which seem to be appearing effectively everywhere. I think by the end of next week, we're going to know a lot more. I want to thank everybody for joining us here at TheoTrade. Have a wonderful holiday weekend. Bye-bye.